Tonight, we begin with a development that banking insiders had feared, dismissed, and quietly prepared for. A move that unfolded not over months or years, but in a single legislative cycle. Days that changed how every American interacts with their own money. Days that handed federal authorities a surveillance tool unlike anything seen in modern banking. Days that put ordinary citizens, not criminals, not terrorists, squarely in the crosshairs of government scrutiny. What the Treasury Department and IRS did here crossed a line that privacy advocates had hoped would hold. And when that line broke, the financial establishment did not hesitate. They responded with speed, with silence, and with a level of institutional indifference that should alarm every person watching tonight. For years now, there had been signals, not from official press releases, not from congressional floor speeches, just signals, that the federal government was preparing something unprecedented in scope. The IRS has been underfunded, yes, but it has been aggressive in its underfunding. Its moves have followed a certain rhythm, a pattern, almost a creeping inevitability. But what set off alarm bells in financial watchdog circles wasn't another audit campaign. It was that the public conversation around bank reporting went completely quiet. Experts who monitor financial regulation know the indicators: the absence of hearings, the silence from Treasury spokespeople, the sudden disappearance of pushback language from banking lobby statements, and the quiet retirement of privacy-focused amendments. All of that went quiet. And whenever Washington goes quiet on a surveillance expansion, it means something is about to get very loud for ordinary Americans. Earlier this year, policy analysts detected what they described as a sweeping expansion of the existing currency transaction report framework, including proposed IRS reporting thresholds that had not been seriously floated in over 2 decades. These are the kinds of rule changes that federal agencies only advance when they are signaling something very specific: a revenue collection surge, a behavioral monitoring program, or a fundamental restructuring of the relationship between citizens and their banks. Financial privacy advocates didn't know which category this fell into, or whether it fell into all three at once. But what they did know was that the government was changing its posture toward everyday banking behavior. And when regulatory bodies shift posture toward private citizens without explanation, even by a small measure, it deserves serious attention. The core of what's happening is this: the existing $10,000 cash reporting rule, which has been on the books since 1970 under the Bank Secrecy Act, was never meant to target average Americans. It was designed to catch drug traffickers, money launderers, and organized crime. But the enforcement mechanisms around it have evolved, quietly, steadily, into something far broader. And now, new proposals threaten to lower that threshold significantly, casting an even wider net over ordinary financial transactions. The warnings issued by financial privacy groups tonight are not normal. They are not routine. They are not symbolic. They are urgent. Source after source describing the current regulatory environment used language that ranged from alarming to historic. The proposed changes have been called overreaching, constitutionally dubious, and perhaps most importantly, deliberately vague in a way that gives enforcement agencies maximum discretion with minimum accountability. But surveillance creep only works if the public doesn't notice. Tonight, many Americans are noticing. Within days of the latest proposals surfacing, financial attorneys, tax professionals, and civil liberties organizations began sounding alarms. These weren't the routine objections to IRS policy. These were coordinated, high-intensity responses from professionals who understand exactly what these rules mean in practice for their clients. Let's be specific about what is actually at stake. The current law, the Bank Secrecy Act, requires banks to file a currency transaction report any time a customer deposits, withdraws, or transfers $10,000 or more in cash in a single day. That's not a new rule. What is new is the aggressive enforcement culture around a related crime called structuring. Structuring means breaking up transactions specifically to avoid the $10,000 threshold. And here's where ordinary Americans get trapped. The government does not have to prove you intended to commit a crime. They only have to prove you were aware the reporting requirement existed and made smaller transactions as a result. That standard has been used to seize funds from small business owners, restaurant operators, family farmers, and convenience store proprietors, people who had no criminal intent whatsoever. They simply preferred to deposit cash in smaller amounts. For that, the government has seized their entire bank accounts through a process called civil asset forfeiture, without a trial, without a conviction, often without even filing criminal charges. They targeted the behavior, they targeted the pattern, they targeted the transaction, which was likely just managing cash flow, and treated it as if it were evidence of a crime. And here is where the story becomes even more troubling. Federal authorities now believe their existing reporting architecture does not capture enough information about the financial behavior of ordinary citizens. The proposals on the table go further: enhanced digital transaction monitoring, potential expansion of reporting requirements to cover transactions as low as $600, a threshold that was briefly proposed for IRS Form 1099-K compliance before public backlash forced a partial retreat. The government wanted to see whether the public would accept a lower threshold without resistance. In 2021, a proposal embedded in the American Families Plan called for banks to report any account with more than $600 in annual transactions to the IRS. The outcry was immediate and bipartisan, but the retreat was only partial. The threshold was eventually adjusted to $10,000 in some formulations, and the underlying drive toward comprehensive financial surveillance remained intact in regulatory agency priorities. You don't get Washington to abandon a surveillance expansion easily, and as of today, the infrastructure for that expansion is still being quietly built. Financial privacy attorneys speaking with journalists under anonymity describe the current regulatory posture as normalization creep, a method of gradually expanding government reach until the expanded reach itself becomes the new normal. But Americans who understand what is happening have proven they are both aware and resistant. Their responses to the 2021 proposal were not only vocal, they were organized, sustained, and effective enough to force at least a temporary pullback. That matters because it shows that public pressure works. It shows that ordinary citizens are not simply passive observers of their own financial surveillance. As reports continued coming in throughout recent weeks, we learned more about the scale of what's being constructed. Banking compliance departments are now quietly expanding their transaction monitoring teams. Financial institutions have implemented automated flagging systems that go far beyond the legal requirements. Fintech companies operating outside traditional banking frameworks are being pulled into the same reporting architecture. All of this is happening within the same regulatory window. This isn't just an update to a decades-old rule. This isn't just a technical adjustment in IRS enforcement guidelines. This is the architecture of comprehensive financial surveillance. And comprehensive financial surveillance is the one thing that privacy in a free society has always depended on resisting. For every public pushback there has been, the regulatory apparatus has countered with something that reframes the terms of the debate. Remember, Washington's original argument was that the $10,000 rule only affected criminals. They thought ordinary Americans would never be ensnared. They thought civil asset forfeiture would remain a niche tool used against drug lords. Tonight, the exact opposite is documented reality. Hundreds of innocent Americans have had their accounts seized under structuring laws. Small businesses have been destroyed by the process. People have lost life savings without being charged with a crime, and the threshold proposals keep getting lower. What makes this moment so significant and so dangerous is that the push for expanded financial surveillance is happening at a time when the IRS is under enormous pressure to demonstrate enforcement capability. Political factions want revenue increases without tax rate increases. Enforcement-focused agencies want expanded budgets. Financial institutions want regulatory clarity. Civil libertarians want hard limits on surveillance. Ordinary Americans want to manage their own money without being treated as suspects. The IRS is balancing these demands while simultaneously trying to modernize decades-old technology systems. And when agencies in that position make sudden enforcement moves, they are not doing it from a place of considered restraint. They are doing it from pressure. They are doing it from institutional vulnerability. Treasury's existing framework, now embedded across every major financial institution, was designed to signal that the federal government is not willing to tolerate unexplained cash flow, regardless of whether criminal activity is actually present. Officials have said plainly that transaction behavior inconsistent with expected patterns warrants automatic reporting. That is bureaucratic language for, we're watching everything, and you don't get to know the threshold. You don't usually hear that level of institutional reach normalized unless something fundamental about the citizen-government relationship has shifted. Meanwhile, financial attorneys and civil liberties advocates addressed the public in direct, urgent terms. They said, the presumption of innocence does not currently apply to your bank account. They said, you can be investigated, flagged, and have your funds seized based on transaction patterns alone. And they said, the legal standard to get your money back is on you, not the government. These are not rhetorical warnings. These are operational realities documented in federal case files across the country. Analysts are now considering several possibilities for where this goes next. One is that the government is preparing a sweeping new digital asset reporting framework that will extend these same rules into cryptocurrency wallets and payment apps. Another is that the $10,000 threshold will be formally lowered through regulatory rulemaking rather than congressional legislation, bypassing public debate entirely. A third possibility, the one worrying civil liberties attorneys most, is that financial surveillance infrastructure, once built, becomes politically impossible to dismantle, regardless of which administration is in power. What we are watching now is a test of whether financial privacy still means anything in America. The government wants to see how much surveillance the public will accept when it is framed as tax enforcement. Citizens want to show that their financial lives are not government property. Tonight, financial privacy advocates are not retreating. In fact, they are escalating. Their response, organized, legally grounded, and publicly communicated, sent a message that the American public understands the stakes. As this story develops, we expect more details to emerge about how far the new proposed frameworks will actually reach. But what we know now is this: the existing $10,000 rule already ensnares innocent people. Any expansion makes that worse. Any lowering of the threshold makes it worse. And any erosion of the standard of intent makes it dramatically, dangerously worse. If regulators pursue these expansions, this moment will be remembered as the point where financial surveillance became normalized. If the public continues to resist with the clarity and force they demonstrated in 2021, then the agencies advancing these proposals have already seen that resistance is possible. And tonight, for the first time in a long while, that resistance appears to be organized. Washington is watching. Too carefully. And when Washington watches your bank account this carefully, it means they are counting on you not noticing. It means they are counting on institutional inertia to do what public debate would not allow. But tonight, Americans learned, again, what they have had to learn many times before. Your money is only as private as the laws protecting it. Your financial freedom is only as durable as your willingness to defend it. And silence in the face of surveillance creep is not neutrality, it is consent. This story is far from over, but tonight, one thing is clear. The $10,000 rule is not a ceiling anymore. The government wants to go lower, and the only thing standing between your bank account and a federal flag is an informed public that refuses to look away. We will be here, watching every detail as the next phase unfolds.